Your next career move could be the one you never imagined. Web3 nomads, everywhere jobs for anywhere people.
All right, and welcome back to Exit Liquidity, episode number 3 with the one and only Captain Rational. We are going to be discussing just the broad world of macro and global liquidity and all the happenings that are driving the financial world. So, welcome back, sir.
It's a pleasure. It's a fun topic. I wonder if I'm going to get to my stream. I got to tell everyone I'll get to my stream a little later today. It's a pleasure to chat about this here, though.
It is. So like I've been watching a lot of your Twitter posts. Oh, by the way, everybody should like and subscribe and comment in the YouTube links. So make sure that we know what kind of topics you want to find out about. Always good to have feedback. So make sure you do that. But moving on. I've been seeing you like focused a lot on the MOVE index, which is interesting and is something I've been, it's one of the top charts on my trading view over here that I've been keeping an eye on. So, and for those that don't know, the MOVE index is a measurement of treasury bond liquidity by way of measuring its volatility. And so back in October, basically when we reached the peak of illiquidity in the treasury market, and the local bottom of equities, that was right here. And we were at very, very elevated levels. So you've been calling this for a while, like when it broke this trend that like, hey, might be time to get long, and that was the right call. So like, I mean, I guess how are you thinking about what's going on now, and do you see the potential for things to reverse from here? Like, what are you thinking?
The first important thing to digest is the significance of this data, the significance of capital flows, and why markets move. So it is all causality, and it's all about knock-on effects. One thing causes another thing causes another thing. Knock-on effects. I've learned to include definitions often as I speak lately.
Yeah,
or recently.
It's good, and I try to do that on here too, because like I digest this stuff for fun, and so it's very easy in this space to just get like pulled into like all the lingo and the stuff that like makes it difficult for people to really understand what's going on in these topics, because like macro gets full. You basically need like a lexicon in front of you for all things finance.
Oh yeah, and then as I talk more on Twitter, I like to give analogies, because one, that's how human beings understand things in context of something else. So I probably could start a little bit of a talk with a tweet that I did to describe liquidity and volatility. Apologies for the profanity, the coming profanity. So volatility is like at a pool club, a public pool club, and a kid shits in the pool. That's volatility. What does the kid shitting in the pool do? Everyone gets out of the damn pool. And then chlorine and cleaning. It takes like 2 hours. 1 or 2 people get in the pool, 3 to 5 people get in the pool, 10, 20 people getting in the pool. It takes time for people to get back in the pool. The amount of people at the pool club is liquidity. When volatility hits, liquidity is in jeopardy and risk, because there's risk of being in the pool. The people in the pool, and they want to get out. They want to protect their liquidity. Their people. They're protecting themselves. So that's a great example of a great analogy of what happens when volatility strikes. Now, a lot of people look at volatility, the VIX, in equities, and the VIX is a second order knock-on effect. The VIX is volatility in equities. And what causes volatility in equities? Volatility in currency. If the dollar is ripping, that means the dollar is more scarce and people need to spend foreign currency, more of it, to buy dollars. So how do you do that? You sell your equities. And we're talking about a planet here of people. So that the VIX is a first order knock-on effect of currency market volatility. And what drives currency market volatility? Bond market volatility. Why? Because as bond yields go up and treasury prices come down, folks know in crypto what happens if your health factor on AAVE gets into jeopardy. Your collateralization ratio needs to be bumped up. How do you do that? You need cash to buy more of your collateral, buy more of your bonds. How do you get cash? First, you got to buy dollars.
Or you got to sell something.
Well, exactly. Well, you're selling. Well, in this instance, they're selling the foreign currency. So bond market volatility starts to affect the volatility of currency markets. You're going to drain FX liquidity, particularly non-dollar liquidity, because the foreign currency is going to be used to buy dollars. So that liquidity is going to come down. Dollar is going to go up, and the dollar is going to be used to basically shore up collateral positions, collateralization health. And all of this has a second order impact on, equity markets, because you got to sell shit to raise dollars so you can actually pay your debts and shore up collateralization health.
Yeah.
So this is why the move indicator is exactly what you saw with regard to the late October bottoming of risk assets. As the volatility of the bond market comes down, that's akin to the chlorine and the cleanup process at the pool. And the liquidity, the people at the pool club for the day are like, all right, I'm just sitting here at the damn pool club. What are they going to do? They're going to get back in the pool. And that's risk markets.
Yep. So I guess there's this whole concept of like global liquidity that's been sort of in vogue in the macro space. It's mostly just talking about bank reserves, right? So there's this idea of liquidity being, and I actually wrote this down so that people could see this equation. Here, let me do this on the, do this real quick. So, man, that lighting is not working out. There it is.
There you go.
You can see it. Fed balance sheet minus the Treasury General account minus the reverse repo facility. So, I feel like this is sort of an important concept to kind of go over, what these things are. Because the Fed balance sheet has been, it ballooned like crazy in 2020. And then the TGA got run down, which is the Treasury General account. That's basically just a big account that the Treasury has at the Fed. And then, so as that ran down, that was when they were pushing all the stimmies out, giving everybody lots of cash. And that, that translated into, people having huge demand for things. And then we were running into all these supply chain bottlenecks and stuff. And then as time went on, the effects of those, that stimulus dropped. But where we currently stand, with the Treasury General account, is that recently it's been dropping. And then that has kind of led to some of this liquidity that I think we've seen in the market, because there's this whole battle over the debt ceiling where, if the TGA can't, or if the Treasury can't issue as much debt as they want to in order to be able to cover their liabilities, then they've got to just kind of they have some tools to like kind of reshuffle things, but like it definitely ties their hands when it comes to like being able to push treasuries out into the market, which that has ramifications. And I think that like there's the potential that we may see some issues there with that, depending on what like tax receipts and stuff do this year too, like because it's about that time. So that, you know, it's tax season. I have not done mine yet. I need to do that. But like, because like after 2021, you know, everybody made buku dollars in 2021 and had all sorts of capital gains to pay. But like 2022, I don't think the Treasury General account's going to be pumping like it was last year from all that. And so it'll be interesting to keep an eye on what's going on with the TGA. And like as that thing pumps up, it you know, going up is actually bad because that sucks liquidity out as far as these bank reserves are concerned. And then the other thing to look at and keep an eye on is the reverse repo facility. So the reverse repo facility, I think of it as like staking for bank reserves. Like if you have some extra ones, you throw them in the old RRP smart contract, and you get a.
That'd be lovely.
And then you get your 4.3% or whatever we're at today. Let's see, what is it? 4.55. Actually, because they just hiked it. So it was 4.33. They just raised it a quarter point. So
yeah, I'm not surprised.
Yeah. So like the other wild card here is like, what if they mess with that interest rate? Because that could be very interesting if, you know, the Fed does something that causes all that liquidity to rush out of there. You know, $2 trillion just falling into the markets could prove to be like extremely you know,
yeah, provocative.
Yes, I mean, you could get a melt up scenario or something like that if that is just suddenly, you know, washed away. But over the last few months, though, the thing that's been happening is the Treasury General account's been dropping, so that's pushing more liquidity into the market. Meanwhile, the Fed has been lowering their balance sheet, and so like those things moving in tandem has basically kept, you know, liquidity you know, from actually dropping, because like the TGA has actually moved down more than the Fed balance sheet has.
So here's the deal, and I feel like I fall into Jeff Snyder's camp. Obviously my content is quite different, but I agree with him in this regard. I think the Fed is marginal. The policy is narrative. The amount of liquidity that they're dealing with and have a capacity to affect is marginal in the global system. It's a fraction of global liquidity. So the balance sheet. So that's like pick a more flammable thing than gasoline. You know, that's just like the propane on the gasoline fire. It's just something more flammable. That's like the afterburner. That's the nitro.
You know, I saw a tweet the other day that fits with this, and somebody said that the Fed decides when rates go up, the market decides when rates go down. And I thought that was a very interesting statement, because like I think that generally has played out in all of the previous iterations, where like Fed is like, oh, we're raising rates. But the thing is, they like that illusion of control. Like it's not, yes. And like you said, they're not necessarily in control. But
no,
they do have an impact, and like sometimes that impact is more outsized than others. Like, but like eventually what happens is the market starts to defy the Fed. And then in order to maintain the illusion, they have to, start going with the flow of the market. Otherwise, they will, lose the illusion itself, which is that
It's
they
just
are in
narrative.
control. It
They
is.
don't raise rates. Their narrative that they want to raise rates is what raises rates, and the market responds, and they're following the market. So they have to follow the market down, and they're following the market up, but they're inducing that a directionality change, a sentiment change in the market merely by their rhetoric.
Mhm.
And they're just a marginal actor. The Fed, the entire United States government, has produced a mere fraction of the amount of dollars on the planet. They are not the largest currency producer on the planet.
They
In
are not.
fact, to such a degree, they barely control the amount of dollars on the planet. And the Fed, as compared to history, when there was less dollars in circulation on the planet, the Fed has a fraction of the amount of power they've had in past decades. And frankly, it's the collateral, it's the
Yeah.
US debt that facilitates the expansion, the dollar creation process, the commercial bank dollar creation process on the planet. So there's a reason why it's like what I was talking before the stream. Everything has causality. You pull on one string, it has another effect. They wanted to issue debt to service domestic capex desires, and that flooded the system with collateral, and the collateral was used to expand the currency supply, and they had acquired power by issuing debt, but now it's having the double-edged sword effect where they issued so much debt that now the rest of the world has much more capacity to produce dollars than the federal government, US federal government.
And another thing to make note is that it's not only U.S. Treasuries that are used as dollar collateral elsewhere in the world. And like one of the things that you realize once you dig deeply enough into this stuff is that like mortgage-backed securities are almost as important as the U.S. Treasury market. Like as like maybe not quite, but like there is a huge amount of like mortgage-backed securities out there that are also dollar denominated assets that, especially the AAA tranches, which are, so just to go over that real quick, like when you securitize mortgages, you make the safest ones like the AAA, and then like you kind of like work your way down into to B, double B, and like there are different tranches of them, and then you can sell those off. So you take the most pristine ones, like Bill Gates's mortgage, you put that one in the AAA, and you just go, all right, yeah, that one's gonna get paid. So you sell off all those like high quality ones, and then like that helps to be used as collateral. And I think you can kind of see what's really interesting about crypto, right? Is that crypto is sort of like a little tiny microcosm of the dollar system. And like you get to see how that system is behaving as far as like its demand for quality collateral. Like if you see people are leveraging their monkey JPEGs that are deeply illiquid.
What's the volatility of them? Say,
Well, exactly. Like but if they're able to do that successfully, there's lots of liquidity to go around. But once people start demanding more and more and more pristine collateral in the crypto space, you see all that CDP money the collateralized debt position stables, you see those market caps just going as
It's the
everybody
cascade.
repays off their loans. And yeah, and you see that like sort of leverage wash out of the system. And you what I like to do is just imagine the exact same things are happening in the traditional financial system, because like it is the embodiment of sentiment for the global dollar system. And so like if you just operate under the assumption that like everything that's happening in crypto is also happening outside of crypto, I think that is a very, very solid place to start. So if you see people going risk on in crypto, same thing is happening elsewhere. And so it's just, a very, very useful data point.
The crypto space front runs traditional finance in many regards because of its permissionless nature and global scale and scope.
Yep. And how quickly it reaches price discovery because there's no legal anything. It's all happening. Oh, this block you got liquidated. Now your money is gone. So
it's really as simple as that. That frictionless nature makes it a very enticing place to deploy capital. The hardest part to digest of what has played out over the last couple of years is that, yes, this is different this time, but it's not what people think. This has nothing to do with numbers. This has to do with what a market is. There was no market prior to 2020. There was nothing. So if we just use the analogy that the crypto space is a market now, because it is, because why? Dollar inflow, because that's what every other market on the planet does. It offers opportunity that attracts capital inflow, and that capital inflow either stays or experiences capital flight. You just look at it as a country, because that's historically what markets are. And what happened in 2022 with the amount of capital flight out of the DeFi space? Sure, there was a fair amount of capital flight, but look how much capital was retained. If you look at the DeFi space as an emerging market, you will have a blueprint for basic best practices for how to inspect the overall behavior and general direction of the market holistically.
Yep.
So I was thinking actually, another meaningful indicator that I would love to find, I don't know if it exists, but we need a volatility indicator for MBS. So MBS volatility.
That would be a very useful indicator. I do not know. Like, I think maybe if I'd have to do some digging to find out like what the GC repo rates are. Maybe there's some spreads you could look at for GC repo of MBS versus US Treasuries or something like that. Like, I do not know of an indicator like that, but I would love to dig in and find one, because that is also very interesting. And just to kind of go back to the MBS thing, like when you look at the size of the hole that was created by people not paying their mortgages in 2008, everybody wanted to blame people for not paying their mortgage as to like why things blew up in 2008. But that wasn't it. That wasn't it. It was the fact that all those mortgages had been securitized and then people levered them up like 50x, creating lots and lots of dollars that were all based on this like, swamp foundation. And then they wonder why their castle fell into the swamp. And that's why, like, I forget the exact numbers, but it was only like a couple $100 billion or something dollars of people not paying their mortgages, but somehow that created a multi-trillion-dollar hole in the global economy. And it wasn't because people didn't pay their mortgages. It's because of that demand for MBSs and the need for pristine collateral, and the same like moving out the liquidity curve. Like this is a concept that like I've never heard anybody else talk about, but this is like kind of a construct I have, is like this notion that like there's like people talk about moving out the risk curve, right? But like during these expansions, you see people moving out the liquidity curve, which is like, you know, moving from like pristine collateral to do your leverage to leveraging, you know, your equity in some private firm to leveraging monkey JPEGs. Like, you know, like that, those are different places on that liquidity curve. And then like the more liquidity is out there, the, you know, the better able you are to move further out. But the problem is it washes back eventually. So,
Sure.
I mean, the idea is as everybody's moving out this way, you want to be trading for good collateral so that when it all washes back,
Yes.
you have something left. And
That's well said.
Yeah. But I was
So
going to pull this
I think
up
that's
real
wonderfully observed.
So here is something I've been continuing to watch, which is the total stablecoin market cap, which continues to not move. So I find this interesting because we've had this giant run up in the crypto space, as we've seen, and like, where's ETH? Here's the ETH chart. Excuse my my drawings here, but like the, you know, ETH's had a nice little run, but the question is, can it last? And some interesting things have been happening. I saw a tweet that you did yesterday talking about the 10-year bond. I mean, that is a bullish engulfing candle right there at the end, if I've ever seen one. So that's interesting. And then on top of that, you have, where's the DXY? Here's the DXY looking pretty spicy today as well. It kind of broke through this resistance here, and then it bounced right back up. This resistance dates back to June of last year, and it's you know, so if we manage to break this sort of out of this channel here that's existed for a bit since November of last year, things could return to being spicy, and like everybody's gonna pretend like they totally saw this coming, and but like right now it feels like everyone is like 100% like, all right, we're back, everything's good, echo bubble, all that.
Oh,
and like it's
not.
I guess the fact that we haven't seen the stable coins move up, that in and of itself is concerning, considering, you know, allegedly global liquidity is increasing. But like,
look,
you know,
look how much. Look at the dollar depreciation. That's how much global liquidity increased. But so what's driving this market right now is the collapse in bond market volatility, which is relieving pressure from currency volatility. And that makes liquidity in the system bored. So it's overall a negative sum game if you're looking from December 2021. It's a positive sum game if you're looking from January of 2020. It's a 35% increase in US produced currency units in circulation. And the collapse in bond volatility, the primary collateral on the planet, you're talking about also an increase in global non-US created dollar currency units. So you have an increase in liquidity all over the place. You also have the relative stabilization of US created artificial liquidity with the balance sheet minus the TGA minus the RRP. So overall, this is a period that we're experiencing this behavior because of collapsing volatility, which means the people at the pool saw the shit get cleaned out of the pool.
And they're,
uh,
they're moving back
they're
in,
going back
trying to
in.
party.
Except that right about now, my sentiment is, like 10 kids came to the pool in the morning, one kid shit in the pool, but by afternoon, those kids called another 30 kids like, hey friends, come to the pool. So right now it's noontime and about 40 kids are at the pool. There was 10 kids at the pool in the morning. So one kid shit in the pool in the morning and there's 40 kids at the pool in the afternoon. What are the odds, 2, 3, 4 kids shit in the pool this time around? So that's where we're at.
Here's another interesting thing that tend to mark local bottoms, right? Or tops for that matter, is like forced selling. And think back to all of the various bottoms that we've had in crypto over the last few months. There was the 3AC. That was when we hit 800 or whatever on ETH. Then you had all the forced selling that came out of all the blowups since then, like FTX and whatnot. So each of those were a sort of forced selling. And think about even in the traditional markets, right? It goes the other way too, because the blow off top in Tesla was the capitulation of all these shorts that had been trying to call the top on that for a long time. And
I'll give an interesting take on Tesla, and this is something that's disappointing but real. Money makes money, and that means the wealthy. And it's realer than people think. The wealthy create bottoms, the wealthy create tops. It's the largest actors, it's the vested interest. What created the top in Tesla was must selling, which drove depreciation. Yep. And that depreciation causes more depreciation, and that spreads like a wave, like a virus amongst the participants, the actors in the space. Selling causes selling. So the largest actors have enough capacity to cause a directionality change. Once the directionality changes, the momentum does the rest. So when Congress sold the top and the Fed sold the top of the S&P, yeah,
with that was them using the SPR was the top of the oil boom. Same thing.
And then the directionality change went. That's it, and then the momentum carries the rest. So they could say what they want. This is basic psychology. Once a large enough force is applied in the opposing direction, it causes the psychological shift in all the actors in the space. So believe it or not, the Fed and Congress in good part cause the popping of the bubble. That is a massive psychological pressure for those types of actors to behave in an opposing direction of the market. Disturbing, because you can't say it, but he can't say it. But this is just basic psychology. It has nothing to do with him, what he wanted to do. This has to do with the behavioral response, the psychological response of myself. If Musk sells, it's going to cause one person to want to sell. But that one person, this reminds me of software development. When it occurs in QA, it occurs in production, even though you're not seeing it in production in the metrics, but it's occurring in the real world. So even though it causes one person to respond, it's 10,000.
Yep.
It occurs even though you don't see it, and before you know it, they're all selling.
Yep. So this is a tweet I think about often, which is nothing like price to change sentiment. And this is to your point that once Musk sold the top, it was, or created the top, if you will. It was lights out at that point, because that was too big a force to overcome.
Yeah.
And it moved the market to the point where sentiment drops. then other people start to cover, and then price continues downward, and you end up, where we were. So
Get your
like,
cycle.
yep. And the study of bottoms and tops is very interesting. Like, and learning those is so, like, I feel like you can do it so much faster. Like, learn the psychology of markets in crypto, just because it's such a pure price signal, that like, and sentiment signal. Like, you can literally just sit on crypto Twitter and you can watch the price moves, and you can watch as sentiment follows price every step of the way, and you get to see like what bottoms and tops look like. And eventually, if you're observant enough, you can start to, like, make some sense of it, I think. But it's
I
still not
agree.
easy in the moment, because
The problem with crypto, the problem with all markets, is understanding why they move. And before engaging with the market, that's the most important thing I tell everyone. Everyone's like, price low, high. I want it to go up. I want it to go down. It's kind of like tennis. Huh, an analogy. So in tennis, you don't look at where you want to hit the ball. You're looking at the ball. So to understand markets, you're not looking at the price. You're looking. You want to assess the people, the psychology. Who is buying something? Why are they buying it? What is their alignment? What is their behavior, their expectations, their goals, so on and so forth? And this plays into risk. This plays into potential volatility. This plays into gains opportunity. And this plays into a lot of considerations. Now, in the crypto space, this is especially difficult because of the micro caps. You have, and it's some of the content that I put out, you have the whales. There's malicious whales, predators, and then there's the benevolent whales. There's a lot of benevolent whales, but few relative to predators. Most capitalize. A benevolent whale is often a founder with vested interest. 100 million market cap token. They have 40 mil. They could be selling and capitalizing, but the benevolent whale doesn't sell because they built something. They built a company. They built a protocol. And a good example of that in traditional finance was Elon Musk. Elon Musk was a benevolent whale all the way through a decade. He never did anything with his capital or liquidate his shares, his equity. But then that evaluation of market participants, they're the primary market participant, is the shark and the fish that I described.
yeah.
Is how long until the benevolent whale becomes the predator and decides to munch. And this is alignment of interest. So you could surf with the predators for a period of time, but at some point the predator is going to capitalize. And in a micro cap marketplace, $10 million assets, someone comes in, buys 5 million of it. You better believe they're a predator. Especially what is their vested interest? What is their alignment? And that is a requirement to assess the potential risk of your principal.
Yep. Yes, indeed. I think crypto trains you to be aware of predators too, in ways that, like,
Hopefully.
yeah, hopefully. I mean, the people that don't realize it, either they learn, and they learn to swim another day, or they get
Are
eaten.
they all? Yeah,
And
unfortunately, they learn the hard way.
yeah,
Unfortunately, it is the nature of capital markets to create capital concentration. Capital concentrates to persons that already have capital. It is not fair. It is what it is. There is no fixing it. Because you can't fix what is the expected behavior. The antithesis of a capital market is the distribution of capital. You're talking about literally capitalism versus socialism. Capital market is the pure manifestation of capitalism. It's this psychological behavior of individuals, and individuals are acting to represent themselves. So as much as it's disappointing, the only way to explore these opportunities is at minimum to start to understand these psychological realities of markets and why people behave the way they do and what are their intentions and what are their alignments.
Well said. Well said. Yeah. That is the game, isn't it? You try to build up your size of your fish so that you too can one day maybe become a whale. But it is not easy because you're fighting against the natural order.
But it works, and it happens for the minority. So
it does.
there's another wonderful analogy. A market is a field of gazelles, lions all around. You got the predators and rabbits. All of a sudden, you have a population balloon in the gazelles. The markets start going up. All of a sudden, there's 100 times more gazelles. The liquidity in the markets is up. The price is up. The lions are like, all right, I'm going in. But by the time there's, a 10x in the amount of gazelles in the field, you got a bunch of rabbits along on, and they're like, oh shit, guys, the lions are going in. Let's go. So the rabbits are, they're going to go in. A rabbit's going to come out. They're going to get a little something. Some of the rabbits are going to come out. Some of the rabbits are going to be eaten by the damn lions. The vast majority are going to be eaten by the lions also, but because of the sheer amount of gazelles out there, the amount of liquidity that has flooded the system, price appreciation, a couple of rabbits are going to come out. That is the small actor. The rabbits are the small actors.
Yes. Yep. The gazelles are too juicy.
Yes, indeed.
There is an advantage to having that is the flip side of that coin, is that when you're a large actor, your opportunity to take advantage of exit liquidity is far less than a small actor who has zero price impact on the market. Like, that's a whole other game. And so there is a bit of like push and pull there, where like, yes, the whales can move the market, but like the thing is, the exit door is only so big. And to speak to the name of the show, which is exit liquidity, the whales have a lot harder time because that exit door, small. The rabbits, small. The whales, big. So like, if you can leave before the whales do.
That is interesting. This is something I actually deal with. But it's not. I deal with it in an unrelated way, but it's relevant because a whale. This is getting into the psychology. A whale can only exit if they buy 5 mil of a 10 mil asset and they push the price up significantly. They don't necessarily have a capacity to exit without collapsing the very market that they want to appreciate to draw in more capital, such that they have a capacity to have the desired exit liquidity. And the question becomes, what are they looking for? What is their goal? How much exit liquidity they're looking for? This is the same thing about VC. This is what VC want. You go public because you want to draw in exit liquidity. It's the whole point of the game. So on occasion, you catch a captive whale that they're stuck. The exit door is too small. In which case, you've observed an appreciated market that becomes a playground for smaller actors, because the whale, they're not. A whale can always choose to destroy a protocol. Rug pull. That's exactly what occurs time and time again, where the majority actor, well, rug pull really has malicious overtones, but the majority actor exiting destroys a market. You destroy a market, you destroy a protocol. So that is a heck of a consideration for the largest vested interest to consider. What is their relationship to the protocol's creator? There's the repercussions of destroying a protocol, but in instances, you could catch a whale off guard, in which case they can't exit, they don't have the liquidity, and now you have a market that's a playground that has been appreciated. I don't know. It's complicated. It's really complicated to dig into the psychology.
Yeah, yeah, it is. I mean, there's, you know, like, so like the short-term actors, right? They have an advantage. And I think that this is why you've seen this happen across markets. Like you've seen this over the last like 20 or 30 or 40 years. The amount of time that people hold stocks has dwindled over time, and now it's like something like 3 months or something is like the median or average, I don't even know, duration that a stock is held. And I think some of that speaks to this you know, propensity to catch these big whales that have a vested interest,
Off guard.
because basically, like, if you don't care, if you aren't playing the game as if it's a continuous game, because the game theory completely changes, right? Like in a repeating game, how you play the game the first time will change how the game is played the second time, the third, the fourth, the fifth. But if you're just playing a series of single games, then you don't really have to take into account your impression that you leave on the market. Like you
Yes.
can just be a, you know, bloodthirsty capitalist that just doesn't care who's you know, liquidity doors he smashes, and like it changes the game. And founders and stuff, they're playing this continual game of like, hey, I can't kill this market forever, so I have to like keep this thing afloat. I have to keep working on this thing, and it's a repeated game. And if even if that project dies, right, like that reputation is coming with them, unless they go full on and start a new protocol. But like that reputation is coming with them one way or another, and like that has the effect of like making them the benevolent whale. It's not that they're truly benevolent. It's just that
There's no benevolent. This is
yeah,
all
it's
personal.
the game theory. The game theory has changed for them.
I'm saying it's
Game
all
theory.
business, never personal. Look at
Yeah.
DYDX. VCs got their lock increased. No, 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 no. If they unlock, everyone expects them to sell because that's what VC does. Why wouldn't they sell? The exit liquidity is shit. They would destroy DYDX. It'd be done.
Yep.
So how do you handle that psychologically? PSYOPs. Extend the lock. They can't sell. If anything, that bolsters potential price appreciation because everyone's like, "Oh, look, they can't sell. The VCs are trapped. The whales are trapped. They have enforced alignment of interest for a period of time." What does that do? It draws in more capital, where
Right.
the little fish can have a playground for a period of time while they're locked. With the whole
Yep.
point being to increase liquidity so they could exit.
Yes.
Simple equation.
It is.
This is a bit of a curse.
It is, but like this is how you need to approach these markets. You need to approach them like from these like game theory is so useful. If you've never read a book on game theory, like I highly recommend pick. It doesn't matter which one, like pick one, and just kind of like read through one, because like it just like it's one of those things that changed the way I thought forever. Like there have been other books and things like that did that, but like once like you learn the core concepts of game theory, like it
What
will
is
change
it?
the way
It's a
you
show
play
I
games.
watched. It's about it's Matrix overtones. Obviously, once you see it, you can't unsee it. Was it The Old Man on Hulu? It's like once you see It's once you see the system, once you see the politics, once you see the spy agencies and the enforcement agencies, and you get caught up in it, there's no escape. You can't get out. So it's a bit of a curse and a blessing, because now you know how to navigate, but you're like, really, this is the fucking system? It's goddamn disappointing, because it's predictable. Everyone acts in their own interest. And this
Mhm.
goes, I like Ayn Rand's philosophy. She talks about the virtue of selfishness. So if you really, I like it. It makes sense to me. But if you accept that psychology, everyone acts in their own interest, even when they're altruistic, because the altruism is fulfilling. So it could all be, every behavior on the planet could be explained by self-interest in one way or another. And that's obviously just a pure manifestation of capitalism.
Yeah, it is. I think there are some people that can't even get out of their own way, and they do things that aren't even in their self-interest. But yes, I think that does explain some behavior. But yeah.
Yeah.
So this morning, just to change the subject a little bit back to the macro realm, they announced the jobs non-farm payrolls,
Well,
and like 8 standard deviations away from the between what was expected and where we ended up, which was like 516,000 new jobs added, which
oh
these
my God.
numbers always need to be taken with a grain of salt. But the thing is, like, that's going to be a big headwind for people that are, screaming that the sky is falling when it comes to interest rate rises. And I don't know, like, it also flies in the face of the whole Phillips curve too, I think. The way we've seen markets play out. The Phillips curve is basically this concept that there's this trade-off between employment and inflation, and that, like, if you keep inflation low, you'll keep employment high, and vice versa. And I think that concept is just complete nonsense.
But it's
And
being offset by poverty. It's being offset by lack of capacity to access goods and service, by debasement of currency. So they might be high employment, but over time, inflation eats away at their capacity, their purchasing power. So you can have high employment, but that doesn't indicate the economy is doing well.
there's that. And then the other part of it that I see is just like, so much of it is demographics too, right? Like in the 70s, you had all these young adults moving into buying houses and needing goods, services, contributing to the economy, and like demanding new stuff, taking on debt, all that stuff, like that pushes inflation, right? And then on top of that, you had the ramifications coming out of World War II. U.S. had all the gold. Everybody was on a gold standard. So you had the Eurodollar system being created overseas, and everybody needed dollars because they needed to get gold or dollars, one or the other. And so that's where the deepest liquidity was, and that created a whole like manufacturing boom and need for all these people. And so you just kind of got this like price appreciation of goods and the price of money increasing because you needed more money than was being created. And the gold standard was too restrictive in order to accommodate that massive growth of users of said dollars.
It's an interesting thing that I've realized about the gold standard. There's a reason the gold window was closed, and it didn't have anything to do with a desire to be on a fiat system exporting debt, the petrodollar. The gold standard was because the rest of the world figured out how to print dollars. and they were literally redeeming U.S. gold reserves.
Yes, they
So
were.
literally, the U.S. said, "All right, we're going to hold on to our gold. You got your euro dollars. You create a euro dollar. You could buy a real dollar, and then you can redeem gold." So
Right.
now everyone else had the capacity to arbitrage gold directly from the U.S. federal government.
And that's why they closed it first. Before they closed it totally, they closed it to foreign investors as a way of like trying to control that. And it's just yet another example of like how capital controls and trying to control the world of finance, it's an uncontrollable beast. Like finance is information, and like you can't really stop information from flowing.
Mm.
And crypto is an embodiment of that. And so like I think that it's just, the gold standard closing was just us finally admitting that the speed with which information can travel had become too much for a gold standard to bear. And I don't think there's any going back from that, like really. Because the free market will make money out of nothing. They will take monkey JPEGs and borrow against them. And as
Exactly.
long as there's sufficient liquidity in the system to allow that to take place, at no point was Jay Powell involved with the creation of those monkey dollars. And like but that liquidity is liquidity, and it is real until it's not. And
Bitcoin fixes nothing. Bitcoin is profound. It's extraordinary technology. If you replace M0 with Bitcoin, it changes nothing. The argument for Bitcoin as it fixes money.
No.
Money is M0. It doesn't change anything. You're going to have M2. You're going to have synthetic currency units. You're going to have leveraged currency units, period. It doesn't change anything. So this brings me back to why I started my content those years ago. What is significant about crypto, and I'm tantalized by it, and it comes out in a lot of my content lately, is my dispassionate sentiment for humans. Humans are a problem. Humans actually, by definition, they have to be the source of humanity's problems, because humanity's problems aren't caused by rabbits, a gazelle. They're caused by humans. So the only source of human problems is humans. So I'm tantalized by AI. It introduces a variety of complexities, but I'm even more tantalized by the concept of determinism. Determinism takes humans out of the equation and makes things predictable. So while Bitcoin doesn't fix money because people have a capacity to create money, or the commercial banking offers a capacity to create money, Bitcoin fixes the Fed. I would argue that is the case. I believe there's humans at the Fed. Oh, I mean, that's not really a far-fetched belief. There are, in fact, humans at the Fed. And I believe humans are a problem. I believe subjectivity is a problem. And I believe determinism is a meaningful fix for the source of problems in humanity, which is humans.
I do sort of agree with that a bit. And to Bitcoin's credit, like I do think that in a like post-Bitcoin emissions world, like having just a pure ledger that nobody has any sway over does add some value, as far as like just being like a pure form of base money. Now, the thing is, like you said, just like the gold standard, just because you have hard money doesn't mean that people aren't going to then lend against, they're going to use their gold. They're going to buy a house. Then they're going to borrow against the house to buy, stake in some company, and then they're going to take their stake in that company and they're going to borrow against that to get, and you move further and further out the liquidity curve, and like you have more and more dollars that are all just kind of based off of this base layer. And
The same
that
thing.
is what it's trying to be. However, the thing is like having a deterministic monetary policy is like, it's definitely the most it's definitely like the best way to like just make it so that humans taint it as little as possible. But the problem is like every choice as far as how that algorithm works is going to have ramifications, and those ramifications may lead to other forms of money taking precedence over that one, and it may lead to certain perverse incentives that society deems to be unacceptable at a given time, which leads to the desire to change it. And like, that's the thing about money. Really, when you get down to it, money is an idea that is shared between all of society. And as society changes, that money is going to need to change too, if the values of that society are no longer what is reflected by their money, and they'll just choose a new money. And I think that's what you're seeing with crypto, right? Is like this whole idea that Bitcoin fixes this. This is a meme that is born out of that notion that the current system is no longer upholding the values that society wants it to. And so people start of their own volition selecting a new money. And I'm here for it.
That's a reasonable take. And there will always be a new money. There will always be something that someone wants to use versus someone else. And what does that take? It takes the large actor to express alignment. If a large enough actor says they like something better, it changes the directionality, and then the cascade happens. It's the same thing with markets. It's all the same phenomena over and over again, the same causality. If a large enough country says they want a different money, other countries follow suit, and over time it happens. So, it reminds me of like what Brent talks about, Brent Johnson, and BRICS, and Russia and China. It's not going to happen anytime soon. So, I think he would agree when I say, in 20, 30 years' time, there's a good chance, in fact, there's probably a likelihood that what they're doing right now is going to have significantly more weight on the planet. It's all about time horizon, and the biggest burden that people have dealing with these markets is time horizon. One example is with the negative sum game, December 2021 until now, but it's a positive sum game 2020 to now with regard to U.S. created currency units. So time horizon is very difficult to process. That's Metcalfe's law. That's why I like what Raoul talks about.
Yes. Yeah, Metcalfe's law does seem to drive a lot of aspects of just it comes back to like that sentiment changing with price. Like, it's the same sort of thing. Like, as networks, it's just network effects. Like so many things, it's just network effects of people's thoughts about an asset,
Yes.
at play. And so, part of like being able to like find tops and bottoms is realizing those moments when everyone feels the same way, and otherwise you're going to get continuation.
Yes.
But like like in the in-between parts, number go up or number go down. Like,
The volatility will drive people nuts. Especially the smaller actor that has the smaller portfolio. A good part of my content lately has been, obviously I'm a moderate size actor. Know your place in the food chain. That's got to be one of the most important things. So, a whale has a capacity to move markets, own markets. They have a capacity to choose to be vested interest. They have completely different capital allocation considerations, and it's relative to the size of a market. So I've been thinking more and more about how to give advice to different size portfolios, and there's going to be significantly fewer opportunities for the rabbits, but that doesn't invalidate all opportunities. So what are so maybe a couple of seconds on some not hopium, but what is considerable for smaller actors, because it's a content that I don't often talk about. Obviously, capital gains always works. So what is it? And this is something I've been meaning to talk about with my wife, and we've been doing a little bit of content lately as well.
I saw that.
Yeah, she's interested. It's a
That's good.
conversation. What does it mean? How do you get started? What do? You buy something. HODL will destroy anyone. Nobody that says the word HODL, that uses that acronym, has a capacity to expose to the time horizon required for HODL. It's just not possible. It's a psychological thing. So capital gains works. That requires exposure to technical analysis. Technical analysis is a manifestation of everything we're discussing: sentiment, behavior, and trends. And you're consuming all of that quantitatively in chart form. So the first thing that new people getting into the space need to digest is the conversion of that chart into psychology. You are looking at the composite man, a little Wyckoff terminology. That's what a chart is. It's the aggregate person moving a market. And that's the first and foremost thing to digest as a new person getting into the space. You don't just throw money around. It's not going to work. This is not a casino, because a casino has odds. Markets don't have odds. Markets have predators and prey. So the people was like YOLOing long into Doge. No, there's someone that has $100 million worth of Doge that's waiting for 50,000 rabbits to ape in when Elon goes on SNL, and they're going to turn $100 million into $500 million, because all they need is a 5x, and you need a 50 bajillion x to turn $50 into $10,000. So they're going to capitalize a $500 million. Then the only protection against that is technical analysis, as well as I would encourage people to become an inspector of Etherscan. There's a holders tab. Now, obviously, this is a lot of due diligence. So the holders, you could differentiate between contracts and people. And people you can inspect on DBank. So the complexity there is you're not able to correlate two accounts. So you can't tell whether two separate accounts are the same person. That's just the way public addresses are generated by a mnemonic phrase. But all of this gives you an edge, gives you some odds, gives you a capacity to understand the people you're playing with,
and what the
their
whales are doing, whether the whales are still in the room or whether the whales have exited the room.
There's always a whale. There's always a whale that's going to buy the bottom, and they create the bottom. So you want to get out before the whale gets out. So you can buy the bottom with the whale, and you're the little fish swimming with the shark for a period of time, and that happens in nature. But at some point, that shark is going to eat the school of fish, which is what they do. So there's one other interesting technology that I think is massive. I think is really, really important, and it's meaningful. And it's what Bancor wanted to do, but obviously Bancor failed in their tokenomics implementation. They could come back, I think, but yeah, it's complicated. This isn't a critique of them. Impermanent loss protection and market making. Market making is a big deal. Uniswap is uninvestable. Could start with that. It's a completely uninvestable asset for countless reasons. Market making on Uniswap, you will lose your money. market making dollars on something like Curve, you'll make money, albeit you're probably not going to outperform risk-free rate of sovereign debt. So it makes it pretty much why you're doing that. Um, almost everything with regard to providing liquidity has principal risk, especially when you're dealing with volatile assets. So it's pretty much a non-starter for rabbits. I think improvement in market making has the potential to be one of the most significant offerings to the average retail actor in maybe the history of capital markets. You know, impermanent loss protected market making, where the market making is hedged appropriately or strategically. So there's one protocol that comes to mind primarily, and that's gamma swap.
Yes. Guessed it.
Yes.
Yep.
Carbon, Bancor's pivot into carbon is interesting. I don't know how far it's going to go. I talked with the team the other day. I think they're looking more into structured products. I don't know how well they're going to hedge impermanent loss or if they're going to offer such types of products. I think they're looking more for the professional investor nowadays with what they're building. But the only one that I think is in a position to offer this type of product and service to retail is like a gamma swap. So that I find that interesting, and I rarely.
I was just going to say, like, market making is such an interesting topic, and we could probably do an entire show on that in and of itself. But like the notion that, like, so in Ethereum, right? Like, your blocks are not like happening at the speed of, like, say, the transactions that take place on the New York Stock Exchange, right? Every couple minutes you got a block. And so, like, and the whole process works such that, like, you're bidding for your spot in that block as to how those are going to be sequenced, right? And so there's a certain amount of fairness there, where instead of it being an arms race to having the fastest equipment to get into like an exchange, instead there's this, you have to meet a minimum threshold of speed, which is the block itself, the construction of said block, and then within that time space it becomes a bidding war as to who gets what. And I think there's a certain amount of fairness there. I think the open question for me is, as we move to layer 2s and maybe even layer 3s, like, or permission side chains or whatever that don't have the same speed limitations, does the liquidity move out there to the world where you can have something more like a central limit order book style, or does the liquidity stay deepest on the Ethereum mainnet, where you have the most competition for block space? And it's an interesting thought, because, like, gamma swap for something like an AMM that exists within this framework of a block every few minutes, I think is super interesting, because you need to be able to hedge differently in that sort of situation than you would in a central limit order book. And then, like, so it's just interesting to me, like, is gamma swap like the end game, or is the end game some sort of market making that takes place on a clob that moves at the speed of light and looks very similar to high frequency trading as we know it now? And I don't know the answer to that question, but it's one I think about.
Questions create questions. Your questions bring a couple of points to mind. I mentioned gamma swap not as as something that's interesting. desperately needs an opportunity to grow their capital in a reduced risk way and outperform risk-free. Risk-free is, it's marginally positive, real. It's not going to get anyone anywhere. Savings doesn't work, so you need to outperform. So what kind of activities can retail do? And that's really what I'm thinking about. It's not the call out gamma swap, but it's heading in the right direction. Is something that has a potential to offer something meaningful to people in a reduced risk fashion. So you also mentioned L2s versus L1s and cost of block space, and what does it mean? What is the impact of transaction speed? So that's a lot, because we're starting to see glimpses of the way this market's going to mature. What we need to assess is what products are best suited for mainnet versus L2s. What products are best suited for basically trivial transaction fees and very scalable block speed versus competitive transaction fees and more so limited block space, which means you're going to have to wait for your transaction to process depending on how much you want to pay. Liquidity is primarily concentrated on mainnet. There's marginal liquidity on the L2s, even if you consider Tron. It's a fraction of the liquidity on mainnet. Opportunity follows liquidity, just as you talk about. You watch liquidity increase. U.S. created liquidity, Fed balance sheet minus RRP minus TGA, and you're going to basically see risk assets generally rise. And then you're trying to identify where that liquidity is going to be directed by due diligence. So liquidity is imperative to follow to find opportunity. Liquidity's on mainnet. Mainnet's the opportunity. Everything else is marginal. So the small actors go to the side chains because of the reduced transaction fees, but what they need to understand is there's reduced opportunity because there's significantly less liquidity. There's going to be significantly increased volatility. You're going to have significantly decreased or significantly increased malinvestment. Things that shouldn't be outperforming are outperforming for the wrong reasons. You see a much healthier market on mainnet. I think financial products are best suited for mainnet. One, deterministic finality. You're not waiting for your roll up to complete. Big money will not expose to L2s. Big money will expose to mainnet. I believe that increasing transaction fees is not a problem whatsoever at all, not even for a second for mainnet. It's the fallacy of the small retail actor looking for an opportunity that sees that as a problem. Goldman Sachs does not give a shit about a $10,000 transaction fee, and we're nowhere near $10,000 transaction fees if they're going to do a $1 billion transaction. It means nothing. So fees on mainnet, the expense of mainnet, means nothing with regard to the significance of L2s. So as I started this rant, we're starting to see what the hell is going to happen. L2s are massive for gaming. Transaction fees are irrelevant. What's pertinent is state. And the storage of that state going back to mainnet is great. So rollups are perfect for gaming infrastructure. L2s are very significant with regard to applications and products, data management, cloud databases, the disruption of AWS. It's destiny. It's just time horizon. AWS and Azure are done in a decade. I don't want to time box it, but they're done inevitably. Bezos has said it himself. So that's cool. So that does give opportunity in L2s for venture capital, seed rounds, for retail, spotting an early stage business. That's not appreciation. That's not the exuberance. That's the malinvestment we see. That's what these protocols that are financial products on L2s that are ripping 10, 20, 30, 40, 50x. It's just horrible malinvestment. And you could be a rabbit running into the field and get a gazelle, sure. But that's not the nature of the market where it's going to be. It's going to be, it's not. People are going to get hurt.
Yeah. And I think to your point, I don't know. There's another protocol that I think is interesting from an impermanent loss perspective, and that's it's called swap finance with like 2 A's. Swap. And that one is interesting because basically it acknowledges kind of the good flow versus bad flow problem that mainnet has, which is, your blocks only update every 2 minutes, but if the prices on Coinbase are updating, in a microsecond over time during periods of volatility, every single ARB opportunity that takes place between the places where price discovery is happening and the users or the liquidity providers of the AMMs in like a V2 or a V3 style AMM, every single one of those that happens is basically, A, that's where all the volume comes from, but B, like that is where the impermanent loss comes from. It's from that toxic flow of price discovery happening elsewhere, and then somebody else taking advantage of that by buying your cheap tokens over here, selling them for a profit over there. And so that's where that impermanent loss comes from. And so the swap solution was to basically have it so that instead of being kind of the linear sort of what is it? Hold on. The formula, the AMM curve of just like a linear price where you have this line and it's like, okay, you need this many units, the price goes to here, and it moves up the curve. It's just a linear K times X, and so the way swap works is it basically says, okay, we'll do this, but it takes into account the fact that what the price is elsewhere. And it says, if the price is this over there, I'm not giving it to you. If the price is like $1.40 over there and I'm selling for $1, I'm not selling it for $1. I'm selling for $1.40. We're just going to move up this curve and skip that whole part where you take advantage of my flow. And so like, that's an interesting concept too. But again, it's like, there's sort of an admission there that price discovery wouldn't happen on mainnet. And so I find that interesting. And I don't know how this is all going to play out, but it is an interesting thing to think about, like whether or not that actually solves it sufficiently on an AMM to keep the liquidity deep in mainnet and not push it into these sort of centralizing places like permission.
The problem with that is, what's the incentive to use it?
Well,
if there's no discount,
the
discount creates the incentive,
right? And it comes at the cost of volume, and that in and of itself is gonna impact your volume dramatically. So yes, but if the only reason people are using your liquidity is so that they can take advantage of it, that's also not terribly sustainable either. And so it is an interesting problem, this market making.
Yeah. So opportunity comes in a couple of different flavors. One of the biggest opportunities is seeing the potential disruption of an ongoing disruption. That rarely ever happens. The last time that happened was 2007, 2008 in a meaningful way. And and Uber did it as well. But obviously Apple and Android disrupted BlackBerry and Nokia. But those were ongoing disruptions. Ongoing disruptions are rarely disrupted. And it takes, like a significant divergence, a radical something radical you can't bet on it. You can't bet on a disruption to disrupt an ongoing disruption. It's just the unbettable. It's max out on the risk curve with regard to speculation. So how do you assess potential opportunity? You have to assess potential opportunity relative to the current ongoing disruption. How does it play into the system? There is opportunity. So given that a disruption rarely disrupts an ongoing disruption, it doesn't mean a new business can't thrive in coexisting with an ongoing disruption. Lyft works very well, even though Uber destroyed taxi service. So what's the perspective to have? Uniswap and Curve own DeFi liquidity. You have to compare to them. How do they fit into the picture? How does a new technology fit into the picture? There's an ARB opportunity. So swap wouldn't sell at the $1.05, they would sell at the $1.40, but you could get the swap on Uniswap or Curve. It's going to ARB on Uniswap and Curve. Uniswap, there's no opportunity for investment. It's useless. Market making loses money, and Uni is useless. So Curve is interesting in that regard. Curve, you can LP dollars, and it's going to get the ARBs. It's going to get the transaction fees. So I think some of the best tech that doesn't really exist right now would be wrappers around Curve that facilitate derivatives of their LPs, to particularly their V2s, because the V2s would have the impermanent loss, and this plays into probably like what's the competitor to Flashbots that does the block creation?
Oh,
Yeah.
Hold on a second. I'm blanking on it. My understanding is they don't actually make all that many blocks, but
yeah. Slips my mind as well.
It starts with a G. I can't remember.
It started with yeah.
I
Anyway,
know what you're talking about though.
So it all comes down to arbitrage. It all comes down to potentially compensating for impermanent loss and focusing on fees. Fees are everything. That is the best opportunity for retail, because then you can save your money. You work, you get a paycheck at the end of the week, and you can get 10, 15, 20% on your money. Denominated in whatever the hell you want to denominate it in, but your principal, it's all about principal risk. Minimizing principal risk is the best opportunity for retail. So, a Curve V2 position wrapped with something that extracts the shit out of MEV, does some strategic long or short to compensate, like a spread of some kind, a strangle of some kind. So that's what caught my fancy about like stuff that Bancor and Carbon are working on is those type Dexable does those types of products. But if you could wrap that around an LP position to extract additional capital, you're able to offset the impermanent loss. Anyway, I'm going out on the speculation train because there's not many opportunities for the small actors, and I would love to see that rather than just pure gambling. I just don't like the gambling.
Yeah, I definitely get that. Well, it has been about an hour and a half.
It's a good one.
Maybe we should. It has been a good hour and a half, but maybe we should wrap this up. And I'm sure I will be having you back for more macro pontificating in the future. But any last insights to offer?
Yeah, it's a pleasure. I love talking about this stuff, and we always have a good banter back and forth. So we should do more.
Indeed.
This is not the start of a new bull market. This is a negative sum game relative to December 2021. There's a reason why it's going up is because collateral volatility is down. But look at all the risks to volatility everywhere. Housing has slowed down. You could easily have a capitulation of one of the housing, the producers, the manufacturers, the builders. If they're not, what was it
or
like?
just some of these illiquid funds that are holding, like, you know, you had BlackRock and all these various funds getting into like buying up residential housing and stuff, like, and all those funds have like basically stopped the ability to get money out of them. And so, you know, what happens when they have to keep rates high? If it happens that way, like, or inflation comes back and rates stay high, like, what happens when these firms become illiquid because some pension fund blows up because they were invested in this illiquid stuff? Like, there's all sorts of ways that like this illiquidity, we've just haven't had anything blow up in a little while here. It's been a few months.
Exactly.
Nobody has shit in the pool for a few months to bring things full
My
circle.
man, you get it. That's it.
Yep, nobody has shit in the pool for a while, but like,
Oh, that's all it is.
yep.
So look, look how many people went to the pool. There's 35% more people that went to the pool than in 2020.
Yep.
That's the
But
liquidity.
like, you know, and as you're paying more for assets, as you're paying more for debt to speculate on assets, you're creating more less actual liquidity and more speculative liquidity, and you know, maybe that gets pulled back in because there's still a lot of dominoes that have not fallen. And it's like,
Of course.
what is not clear to me is that the dominoes are done falling. Like, because I just don't see that anything's really been fixed. And like, to be fair, nothing has been fixed since 2008, really. But like, but I think that things were patched up sufficiently well that, you know, we were able to keep this boat going for a little while. And so have we actually patched anything though? Like, no. Have we improved liquidity abroad in a meaningful way that is sustainable? TBD.
You know what I love? And I love the way Raul thinks. He comes from way before, 2008. There was a reason he was looking for the solvency flush in 2020, because that's how you clear the system. We never had the solvency flush.
No.
So that is exactly what you just said. There's nothing been fixed in 2008. But I find it fascinating because that's what he was looking for. He never got it. And it's not about whether we get it or not. That's just the risk that's on the table. And look what's going on with earnings. Higher for longer? Is there going to be a solvency flush? This is risk when you deploy capital. There's more reasons than ever for the volatility in collateral to spike. The volatility in collateral causes the volatility in currency. The volatility in currency causes the dollar scare to service the collateral. And there goes risk. So the best thing I can conclude on is look for the flip in move. I would love to be able to assess MBS volatility because that MBS volatility will be marginal compared to collateral volatility, albeit it's a type of collateral, but move is representative of a much larger market. So if you see a volatility spike in MBS, could trigger a volatility spike in move, bond market volatility, which would trigger the currency. So it is a wonderful foreshadow. It is an indicator. And if you look back to 2008, if you followed move, you were out about 4 months before the system collapsed. Now what does that mean for now? Maybe I'll continue this on my stream.
It means watch move.
Move is everything. Now the question becomes what are lower order impactors on collateral market volatility. But the market has become it's resonating. So you get the higher peaks and the higher troughs. There's more capital in the system. It's more volatile. So what is my expectation is higher frequency. So in 2008, you had about 4 months move blew through the TWAP on the monthly. and then you had about 4 months before the system collapsed.
Yeah.
So look for less frequency. You're going to have less time to react. If you see, so this is such a goddamn good, incredible chart. Look at the directionality. What have we talked about? Directionality does not stop. It does not stop and just reverse. There will be
Nope.
last gasps of directional continuation, even if something blows up that causes collateral volatility, because the trend wants to continue. It takes a lot for the trend to stop and reverse. Look at those moving averages, but that's on the the 4 hour. That's on the weekly. Sorry.
Yeah. So these levels that we're sitting at here are kind of like October 07, right? Like, or November 09. So that was sort of like the sort of all clear as far as, like this, but this, going from here, which is September 08, that was when the shit really hit the fan. And then, we bottomed, this big move down, we bottomed in March of that year. So like right here. So that big move down, that was the bottom of equities right there. It's like right here. And, and then we just kind of continued to go about our day. And maybe this was the big move here. Maybe this was, or maybe this was just this part right here where you've just seen the foreshadowing to the main event. And it's hard to be sure.
Voila.
It's hard to be sure. Like, but you have to admit that at this level, we are at volatility levels that are only seen during
crises
in the market. And so like you got 2020 here, you got this, you got 08, and then you got 13, that was the Asian financial crisis, or no, that was the I believe that was the Eurozone crisis. So like, yeah.
Look where you are.
Keep an eye on this chart if you do nothing else, because like you said, if your collateral depreciates on you or starts behaving errantly, like it makes every part of the system, like there's a supply chain of dollars that exists, right? And just like when the price of eggs goes haywire and the people that are making your egg sandwiches, they might proactively raise the prices of their wares. The volatility is a cost in and of itself, because the people that are market making that business need to hedge that volatility. So low volatility, bad for business. That's costs that they have to pass along to the consumers of that liquidity. And so as those costs get passed on, it's going to reflect elsewhere in the form of everything in inflation, so like, which then will make central banks do more of their hawkish rhetoric. And this isn't necessarily over. Now, if we proceed down through this area of slight resistance here, like right in this vicinity, like if we get down below 90 per se,
you can see a heck of a rally.
Yeah, at that point, it's just push the chips in. This party's over for a little while, but it's just one of those charts that you definitely want to keep an eye on, because it, just like the DXY, like you said, this wags the DXY. Like,
yep,
the DXY is ultimately beholden to the overseas dollar funding market liquidity. And when volatility spikes, liquidity costs more.
Get scared. That's right.
Yep.
Good stuff.
All right. So until next time, don't be exit liquidity. And
That's
when you
right.
see shit in the pool, you run.
That's right. Kick craps in the pool. Get out of the damn pool. Thank you, everyone. It's
All
a
right.
pleasure.